Hello dear students. In the previous video we have discussed with the various kinds of risks, that is commodity risk, stock market risk, interest rate risk, credit risk, counterparty risk, liquidity risk, interconnection risk and the bottom line risk we have discussed, right? So in this video further we will be going to discuss the various types of risks. Okay, the further type of a risk is duration limit. Okay, just I'll say one example for this. Our contract began on 1st April and the standard period is for every few derivative contracts are 3 months. Okay, so if any type of a conflicts or if any type of a mismatches happens in the mind of an investor, then they will be ready to end up with a contract as and when they wish. Okay, at that situation this duration limit is the one of the biggest risk. Okay, in OTC market they as and wish they can end up with a contract, but in exchange traded market it's not possible to end up with a contract as and when the investor wants, right? So there is actually this duration limit will be going to arises. Okay, there is a contract expiration date in derivatives. As soon as the date comes to due, the contract gets expired. Okay, in case of if the investment doesn't work out in that specific time period, it may result in losses. Okay, means if the investor waited till the last day or till the maturity period of the contract, then they will incur the moderate profit or extra profit. If they are not waited till the maturity period, then they may incur with a loss as well. Okay, this is one type of a risk. And how this can be mitigated by the investor while investing in derivative market means it need to be that is, as an investor they need to wait till the maturity period comes to an end. Okay, if it so, then no problem will arises. Okay, so the next type of a risk is volatility. It is a risk where the underlying security of the contract constantly changes its value. Okay, that is, underlying securities value if constantly changes, then it is one type of a volatility risk. That is, you have written in the assignment, that is in that column you have the underlying security value, right? If it changes very rapidly, then it is also one type of a risk. Okay, volatility can affect to an extent where one party ends up losing the entire value overnight due to fluctuations in prices. If volatility happens, then of course the share prices will also going to get variated, right? If that variations takes place, then it's a biggest problem for the investor. Okay, that is, before you deal with the derivatives trading, you need to learn to manage these risks effectively. That is, how you can manage effectively means just you need to have the idea about how the fluctuations will be going to take place. That is, a mere prediction can be done. Okay, if that mere prediction is done in a smoother way, then there will be no problem for the investor. In the world of derivatives, the market is never secure, right? It is not a secured one. They have to be a vigilant trader to trade in such an avenue. That is, investor need to be very keen knowledge about everything. They need to have knowledge about everything and they need to take care of their invested avenue. That is, there are majorly 4 portfolios, right? That is stock options, stock futures, index, right? So we need to take care of our invested value. Okay, that how it can be secured or how it can be safeguarded means we need to have certain things as like one benchmark. Okay, if there is one benchmark for it, then there will be no any volatility or fluctuations will be going to taken place. Okay, the next type of risk is price risk. Okay, this price risk means nothing but the stock market prices, it will be get variated if market is not constant. Okay, because market is constant, then the stock prices will not that much get fluctuated. Okay, that is price risk is an extension of the market risk. Price risk is the risk to earnings or capital arising from changes in the value of portfolios of financial instruments. The degree of price risk of derivatives depends on the price sensitivity of the derivatives instrument and the time it takes to liquidate or offset the position. Price sensitivity is generally greater for instruments with the leverage, longer maturities or option features. Okay, price risk is one of the extension of the market risk. Okay, that is, if market is constant, then there will be no variation in the stock prices. If there is no constant market, then the stock price fluctuations or the contract price fluctuations is so common. Okay, price risk can result from adverse change in equity prices or commodity prices or basis risk. The exposure from an adverse change in equity prices can be either systematic or unsystematic risk. That is price risk, which is purely related to the systematic risk and unsystematic risk, which I already told you. As equity markets can be more volatile than financial markets, equity derivatives can experience larger price fluctuation than other derivatives. That is, equity derivatives is one of the most riskiest avenue. That is stocks, stock futures, stock options, right? Commodity derivatives usually expose an institution to higher levels of price risk because of the price volatility associated with the uncertainties about supply and demand and the concentration of market participants in the underlying cash markets. That is, commodity derivatives market is also one of, there also this price risk will be going to arises because those are all the needy items, right? If there is a price fluctuation going to take place in the needy items, then it is also one of the risk for the investor. If the underlying asset value is going to increases, then automatically it is a beneficial for the seller, but it is a it will be going to make a negative effect on the buyer, right? Price risk may take the form of basis risk or the risk that the correlation between two prices may change. That is, it will be going to form one of the basis risk. Okay, and it is going to takes the correlation between two prices. That is, two prices means nothing but price risk and the market risk. Okay, so if market is constant, then there will be no problem. If market is not constant, the price will be going to get fluctuated by the external threats. Okay, and how this can be mitigated means, as far as possible, we can make a control of internal things, right? Along with that, certainly we need to predict how the external threats can also be controlled. Okay, if the external threats will be controlled, then automatically the market risk will be going to get reduces. If the market risk will be get reduces, then automatically this price risk will also get reduces. Okay, so this is about the price risk. And the next risk is operations risk. Like other financial instruments, derivatives are also subject to operations risk or risks due to deficiency in information systems or internal control. That is, while investing in certain avenues, if we don't have the sufficient balance to make an investment there, that is one of the internal control, that is internal deficiency, right? And the risk is associated with human error, system failures, and inadequate procedures and controls, right? And this is very controllable risk only. Here it is not a major problem for the investor. In the case of certain derivatives, operations risk may get aggravated due to complexity of derivative transactions, payment structures, and calculation of their values, right? That is, operations risk means as I already told you, this derivatives market is one of the major, and it is one of the crucial type of a transaction which will be going to take place on a daily basis. Okay, so if these type of a risks, that is internally arises, then it can be controlled by an investor, and the further transactions will be made easier. Okay, the next type of a risk is legal or compliance risk. Okay, derivative transactions face risk to earnings or capital due to violations or non-conformance with laws, rules, regulations, prescribed practices, or ethical standards. In certain ways, how it will be means, there are certain rules or certain set of rules which are really crucial to adjust with those. Okay, say for example, in the earlier classes itself I have told you, that is the commodities will be traded on only the 28 types of items, right? Apart from that, we can't make a transaction with the other commodities, right? So if those type of a set of standards will be prescribed, then we need to accustomed with those only. We can't go with any other. Okay, and this is also one of the major problem. The risk also arises when the laws or rules governing certain derivatives instruments may be ambiguous. Compliance risk exposes an organization involved in derivatives to fines, civil money penalties, payment of damages, and the voiding of contracts. Besides, legal and compliance risk may adversely affect reputation, business opportunities, and expansion potential of the organization. That is, whatever the laws or whatever the set of rules or regulations put up by the SEBI or any financial monitoring body, if those are not practiced by an investor, then it is one of the biggest problem for, or biggest risk for the investor. Okay, and how it need to be mitigated means, it's nothing but it's very simple, just they need to follow the rules and regulations. Okay, if the rules and regulations will be followed, then there will be no problem for the investor. Okay, and the next type of risk is foreign exchange rates risk, and this foreign exchange rates risk will be going to arise absolutely in currency derivatives and LIBOR and WIBOR, those kind of transactions. Okay, derivatives traded in the international markets are also exposed to risk of adverse changes in foreign exchange rates. Foreign exchange rates are very volatile. Foreign exchange risk is also known as translation risk. Foreign exchange rates risk in derivatives is the risk to earnings arising from movement of foreign exchange rates. This risk is a function of spot foreign exchange rates and domestic and foreign interest rates. It arises from holding foreign currency denominated derivatives such as structured notes, synthetic investments, structured deposits, and off balance sheet derivatives used to hedge accrual exposures. Means I'll just sum up of this para. That is, foreign exchange rates, it will automatically arises in the foreign transactions of the currency derivatives market. Okay, say for example, our that is our rupee value in front of a US dollar, it is 79 rupees something, right, as of today now. So just to see, if we are going to buy $1, then we need to pay 79 rupees, right? So this is says about the value of the money, okay, of the countries, that is various countries, okay. So this foreign exchange rates is one of the major risk, because we need to transact with the international bodies, and we need to have certain translations as well, okay. And in certain countries they don't know English, and we need to adjust with that, right? These type of risks will be going to arises. So it can be mitigated by having the proper knowledge, okay, because daily 1 or 2 paise or 3 or 4 paise or sometimes 1 rupee or 2 rupees, the increase or shiftment in the value of money is very common, okay. Just we need to go with the flow, but we need to have the flow where we want to take it, okay. This is about the foreign exchange rates risk. And next is transaction risk, okay. This transaction risk, it is daily occurs, because uh, the market, it is always starts 9 a.m. So the price at 9, which will not be there at 9:30, okay. And the price at which 9:30, it will not be same in 12:30, okay. Per second to second, or per minute to minute, or per 1 hour to 1 hour, okay, the prices will be going to changes of the each and every securities of each and every contract, okay. Another risk is associated with derivatives, it's transaction risk. In fact, transaction risk exists in all products and services. Transaction risk is a risk to earnings or capital arising from the problems with the service or product delivery. This risk is a function of internal controls, information systems, employee integrity, and operating processes. Derivatives activities can pose challenging operational risk because of their complexity and continual evolution. Thus, derivatives are subject to various technical risks. The problems surrounding the use of derivatives in recent years have primarily been due to difficulty in understanding these risks, and thus using appropriate derivatives for risk management purposes. Derivatives use is sometimes misunderstood because, depending on the terms of a derivative, it may be used to increase, modify, or decrease risk. In addition to the technical risk highlighted herein, there may also be a fundamental risk that the use of these products may be inconsistent with entity-wide objectives. Okay, see, this transaction risk means it's a daily risk. Okay, if I am an investor, I am invested on stock future of Reliance. Okay, at that situation, I have started trading on the Reliance. Okay, I have traded on 1 day and second day, third day, fourth day, and I have got moderate profit. Okay, and but on the fifth day of the transaction, I slightly feeling that there will be a price reduction. Okay, at that situation, what we need to do is we need to stop, or we need to hold the particular security investment or the contract investment, and we need to shift for other contract which we have in our hand. Okay, if this can be done, then this transaction risk will be going to decreased or reduced. Okay, And the next type of and the last type of risk is exchange rate risk. Okay, this one and the foreign exchange rate risk, those are same only. Exchange rate risk of foreign exchange, forex risk, is an unavoidable risk of foreign investment, but it can be mitigated considerably through hedging techniques. That is, we need to disperse the risk. Okay. To eliminate forex risk, an investor would have to avoid investing in overseas assets altogether. However, exchange rate risk can be mitigated with currency forwards or futures. The exchange rate risk is caused by fluctuations in the investor's local currency compared to the foreign investment currency. These risks can be mitigated through the use of a hedged exchange traded fund or by the individual investor using various investment instruments such as currency forwards or futures or options. Exchange rate risk isn't completely avoidable, but it can be mitigated. Okay. So these are all the different types of risks which we can find out in the derivatives market. Okay. So if you have any doubts now guys, please put in a comment box and I'll answer your queries. Okay. Thank you. And in the next video, we'll move further with the last concept, that is derivatives, hedge and insurance. Okay.